As we head towards the end of the year, many investors are looking for ways to manage their portfolios more efficiently, especially when it comes to taxes. Market volatility can create both challenges and opportunities, and understanding how capital losses and gains are treated can make a real difference at tax time. To help break down some of the key strategies investors often hear about, including important rules and where they apply, I'm now joined by Brendan Caldwell, director at Caldwell Securities Limited, for a closer look at how all of this works. Brendan, thank you so much for the time.
Well, thank you, Theresa. I love that lead-in clip with the New York governor speaking in front of what looked like a Union flag. Of course, it's the Ontario flag, but all you could see behind her was the stripes of the British flag. I just thought it was a nice touch. Anyway, yes, New Year's should be interesting. What do you want to know?
Now, Brendan, let's start with talking about what is tax loss selling. And would you mind breaking down how that works?
Well, sure. Well, you get toward the end of the year, and people go, what's been terrible? What can I sell and take some losses? I got all these gains from this year, from last year, from whatever. What can I sell? It's got losses. So he who has will be given more, and he who has not, even what he has will be taken away from him. So what you're seeing a lot of right now is the stocks that have done well are doing even better because nobody really wants to sell the stocks they have big gains just before the end of the year, thereby triggering a capital gain. Flip side is the stocks that have done poorly this year tend to do even worse leading up to the end of December because people are inclined to want to get rid of their losers for just to offset the gains that they might have had otherwise. So people are making decisions for other than investment reasons. They're making decisions for tax reasons, which normally speaking ends up being a mistake. The thing you sold because you were frustrated with it will probably bounce in January. The thing that you didn't sell because you didn't want to trigger a gain in 2025 may in fact have a correction early next year. You don't know, but decisions made for tax reasons can, to a greater or lesser extent, backfire.
Now, on the other side, there's tax loss buying. Would you mind explaining what that is and how that works?
Oh, yeah. Well, if you got an anomaly in the market, like I just described, where people are making investment decisions for other than investment reasons, it creates opportunities. So if they're selling something for, well, any reason, but in this case, particularly tax reasons, and if they're selling stocks that they don't like or haven't done well this year, the real estate sector hasn't done well in the U.S. I think it's the only sector in the United States that hasn't rallied. I can't think of anything off the top of my head, but if there are individual stocks that you like that have had a bad year, probably this is the best time to buy it because anybody that was going to sell it is probably going to sell it here in December, leading up to the end of the year. So if there's a sector you like, a stock you like that's getting pounded in December, probably the odds are better than they are worse to that you'll see something of a rally in January. So tax loss buying is taking advantage of other people's tax planning for good investment reasons. So other people are making decisions for tax reasons. You can take advantage of that for investment or trading reasons and potentially make some money.
And what about the 60-day rule when it comes to tax loss selling?
Okay, so what they're trying to do with that, this is again a Canadian thing, is they don't want superficial losses, and they've tried to actively discourage day trading. I don't know why. I mean, I think more trading in Canadian stocks would be better than less. But if you buy a stock, you had to have owned it for 30 days and then sold it for 30 days in order for you to be able to trigger a tax loss on it. So if there's something you bought, you had to have owned it at least a month, and you have to have had it out of your portfolio for at least a month in order for you to be able to claim a tax loss on it. So I guess what they're trying to do there is to make it a genuine loss, not what they call a superficial loss, where you're just taking a loss for a moment, or we're still perhaps manipulating the market in order to generate a loss and then have it snap right back. So it's meant so that long-term investors can crystallize gains or losses, but meant to prevent short-term traders from being able to do the same.
And does tax loss selling work for a registered account such as an RRSP, RRIF, or a TFSA?
No, no, it doesn't. And actually, as far as I understand it, again, I'm not a tax advisor. I'm wading well into tax territory here. But if you sold something outside of your RSP and your regular investment account, and then bought the same stock in your RSP or your TFSA, it actually negates what you did outside your RSP, although the two have nothing to do with each other. That's my understanding. Any tax advice, check with your tax advisor. But that's for out of an abundance of caution. That's simply how I would treat it. Anyway, no, because in a TFSA, RESP, RSP, LIRA, LIF, RIF, all the various and sundry acronyms of these government tax department sponsored savings plans, all of those are tax deferred or tax exempt plans, such that any gains or losses don't count towards your taxes. So if you make a great big gain, wonderful, it's yours to keep, except of course when you're withdrawing it from your RSP, for example, you have to pay tax on it then. And I'm increasingly beginning to wonder whether it doesn't make sense for people to much more emphasize their tax-free savings account rather than an RSP. And here's my thinking is, yes, if you have to pick, an RSP will save you money as a contribution, but if what you invest in does well over a long period of time and you generate enormous capital gains, when you take it out of your RSP, you're not taxed at the capital gains rate, you're taxed at the income rate, which is, well, twice as high. So I think if you're going to buy things for long-term gain rather than income, I would suggest doing more of that in a person's tax-free savings account. But tax losses and all that don't really apply because those accounts are not day-to-day taxable.
Well, Brennan, thank you so much for the time.
Thank you, Theresa, and a Merry Christmas.